These days, everyone's on pins and needles when it comes to the economy, the labor market, the state of inflation, the next Fed chair, where we go in 2026. I want to bring in now someone who's very central to all of that, Fed Reserve Board Governor Stephen Miran. And Stephen, we got to start with this CPI number yesterday. People went nuts. They lost their minds. Of course, I've been questioning this government data for about 4 or 5 years, and everyone said, don't worry, it's the gold standard. Now it's not. But you put out an interesting post about it. I mean, essentially, we're going in the right direction, aren't we?
Well, we are going in the right direction, and we've been going in the right direction slowly. One of the points I've been trying to make is that we've been measuring inflation in sort of a funny way. And there are some quirks of the measurement process that make underlying inflation appear like it's biased upward. But the truth is that once you adjust for these, underlying inflation is actually running pretty close to the Fed's target already.
What are the adjustments, though? Because you still have the hawks, your colleagues who have been hawkish, and they've pointed to, persistent inflation where it's just, still won't bend, and they still point to housing.
Yeah, so housing is one of them, and there's a quirk of the way that inflation gets measured, which, to be clear, it's not to say that this is wrong, it's just this is how it's done. Because most people only reset their leases when they move or re-sign their lease. They don't actually see the rent increase until they actually do that lease reset. So measured inflation, which tries to capture that, lags substantially behind the rate of lease inflation in the actual rental market, right? So the rent that you see when you go up to Zillow or whatever and you pull up, hey, what are apartments or homes renting for? It takes a while if you're a current renter, it takes a while for you to catch up to that because it doesn't do so until you reset your lease because you move or you renew. But we know that process of catch-up is about done. And there's a variety of reasons why we know it. One of those is that market rents, if you look at the rate of market rent inflation, it's running at about 1% for a couple of years now, right? So that's been biasing the calculation of inflation up. We've failed to account for the very clear signals in the housing market that there really is not much of a supply-demand imbalance there right now. Housing inflation has been pretty stable at a low rate for a couple of years in a market rent sense. And it's really only a matter of time now until the measurement of this inflation catches down to where the market really is.
Are there other areas that you would like to see or that we should consider when we're trying to measure inflation in addition to that?
Yeah, so another one that I flagged in a speech that I gave on Monday at Columbia University, where I did a Q&A as well with former Federal Reserve Vice Chairman Rich Clarida, is what we call imputed prices of non-market transactions. And basically, if there's a transaction going on, you're buying a meal or you're buying a tank of gas or whatever, a gallon of gas, whatever it is, you see the transaction, you see the price, but for a lot of things that we consume, we don't actually see the transaction occurring. And so as a result, the statistical agencies do what they call, they impute it. It means they estimate it based on a bunch of other stuff. And one area where this has led to a lot of noise in the measurement process has been for portfolio management services. And so if you're a saver, you've got a portfolio, you've got a 401k, you've got an IRA, you've got whatever you got, and if you may own some ETFs, you may own some mutual funds, you may hire a financial advisor, right? Those are services that you're consuming, and those actually get imputed. And the way that those get imputed basically ends up tracking the stock price, the stock market price. And so if the stock market moves higher, and
is that why it's rocketing like that? I mean, the number comes in, and I'm like, golly, this is crazy. It's like usury if this is true.
Yep. That's exactly what's happening. So the stock market can move up for any reason. It could move up because of AI. It could move up because of tax policy, tax cuts. It could move up because of regulations. It could move up because growth is better. It could move up for any reason at all. And that gets recorded as an increase in inflation. But in reality, all that's happening is an increase in quantity, not an increase in price. So if your portfolio is worth more because the stock market goes higher, you're consuming more asset management services, right? And yet that increase in quantity consumed actually gets recorded as an increase in price consumed. So we're mismeasuring these things, and that's biased inflation readings upward. And so my proposal is that we take a measure of underlying inflation that abstracts from these imputed prices that I think are being measured with bias, and that abstracts from them. And if you look at underlying inflation as market-based core, meaning you get away from the imputed prices, and then you X housing as well because of these problems in the housing market, it's running about 2.3%. That's really within noise of our target.
Yeah, and of course, we showed the X post that you did with that. That's not real. That's not real. I didn't know you had such a great sense of humor.
It's not real. Yeah.
Okay, let's talk about the other part of this, because you've been the outlier. You've wanted 50 basis point cuts. Because you're more concerned about the labor market, I suppose, than everyone else. There's a great piece out, a chart T.S. Lombard put out, and essentially it shows where economists are just notoriously slow on recognizing runaway unemployment. And what scares me is that if that is the case, and that, then by the time all of them collectively see it at your colleagues at the Fed, it's going to be an acute problem.
Yeah, so this is why it's so important that policy be made forward-looking. There are lags with which monetary policy hits the economy. If we change interest rates now, it doesn't hit the economy immediately. It takes, most people think, about 12 to 18 months to filter through into the economy. So we got to make policy now for 2027. Right? And if we're looking at things like the housing market, those are really based on market prices from 2022, 2023, right? When you look at where the actual recorded measured shelter inflation is. So we should be making policy on a forward-looking basis, not on a backward-looking basis. And if you wait to sort of see it in the data, if you wait until there's an unmistakable trend in the data, you'll be too late. It'll be too late to stop it. In an ideal world, we'd be moving monetary policy around, and you'd never see any variation in the data because we would have gotten rid of it by getting policy right to begin with.
Instead, we wait for old data that's then later on revised even more, significantly, and it feels like that's why we're always behind. That rate hiking cycle to me was an embarrassment because they waited, then they were tepid 25, then they did 50. All of a sudden, oh my God, 75, 75, 75, 75, and it just whipsawed the economy.
Yep.
And Main Street pays a price for it. And I want to ask you about. So Scott Besson has been out there. He's talked about sort of a financial system, including the Fed, that's aimed for Main Street, not Wall Street. Could you elaborate on that? Because I've been saying that for so long. I'm a big believer in the Jekyll from the creature from Jekyll Island. That I just feel like until rich people suffer, the entities that are in control of things don't really act.
Yeah, so look, my perspective is that the Congress assigned the Federal Reserve a statutory mandate of targeting maximum employment and stable prices. And both those are conceived and meant to be interpreted with respect to ordinary families, right? Main Street. Now, they didn't tell us, sort of go out and make sure that Wall Street's always prospering, or they didn't also go out and tell us, hey, go punish Wall Street, right? Like, I want to do the right thing for American families. I want to get the labor market as strong as it can be. I want to get prices stable, right, so that inflation is well behaved.
Well, let me ask you then, labor market as strong as it can be, when wages go up to a certain level, it's a red flag for the Federal Reserve. But it feels like then that means there's a cap on what the Main Street can make. If wages are up 5-6%, they're too high. They're going to trigger inflation. Here comes the Fed to the rescue to tamp that down. How can Main Street ever get ahead? How can we catch up to that spike in inflation that we're so far behind on?
It depends why wages are going up. If wages are going up because of productivity growth, if wages are going up because of new technological innovations or because of government policy leads to better organization of resources in the production process through better regulatory environment or tax policy, then wages can grow up for non-inflationary reasons, right? But from a monetary policy perspective, if wages are going up because the labor market is what we would think too tight to be able to maintain stable prices, then that absolutely is something that monetary policy would want to pull back. Now, that's very far from where we are now. Mm-hmm. The labor market has been loosening for a couple of years, right? That's been a steady pace that's been ongoing for a couple of years now. And if it keeps going this direction and we don't change policy enough to arrest it, we will end up in a bad place in 2027 as a result of that. And that's why it's so important for us to get policy into a better place now, because inflation is not a problem going forward, but the labor market continues to be on a trajectory that the Federal Reserve should arrest.
Big debate over whether or not the Fed has started QE, and if it hasn't, is this a signal that QE is being teed up?
The Fed has absolutely not started another round of quantitative easing. So what we're doing is we're buying more assets, more securities for reserve management purposes. Now, over time, the amount of reserves the amount of banking reserves the banking system needs will naturally trend higher for a couple of reasons. One, the banking system grows, therefore it needs more reserves. Two, the amount of currency that people demand grows because the economy grows. We need to provide more reserves in response to that. And the reason why it's so powerfully, emphatically not QE is because we're expanding reserves by buying treasury bills. Treasury bills are very short duration instruments with no interest rate risk. It's like we're swapping one short-term asset for another short-term asset. There's no real consequence there.
Along that line of thinking, should the Federal Reserve pay banks essentially not to lend money to Main Street?
That's not really how I think of it. I think of it as the Federal Reserve, together with the other banking regulators after the financial crisis of 2007 to 2009, instituted an aggressive regulatory regime. That, in my view, went too far in terms of overregulating the banks. That overregulation created a very strong and very persistent demand for reserves. that regulatory-driven demand for reserves means that we have to provide reserves into the system because the banks require them to meet their regulatory requirements. Right? So in that sense, the Fed has to keep a strong balance sheet because the regulations require it.
But if we get deregulation, then that should be less of an onus on the Fed to have to do that. I mean, we want to encourage these banks to lend.
Absolutely. And I've called this regulatory dominance of the Fed's balance sheet, right? We have to have, the balance sheet is at the end of the day being driven by the regulatory environment. Now, my hope is that we continue right-sizing the regulatory apparatus in the banks so that they can lend into the economy. And as we right-size the regulatory apparatus, as the banks lend into the economy, we will be able to reduce the amount of reserves the system requires because there will be less of a regulatory-driven bid for those reserves. So we stopped rolling down the balance sheet. We restarted reserve management purchases. My hope is that we get more bank deregulation under our belts, and then we can resume the process down the road in the future of drawing down the balance sheet.
Stephen, stay right here for a second. We just have to take a quick break.